Welcome to The Truth About Real Estate. I'm Erin Blaze. Historically, Columbia, Missouri has been blessed with a stable real estate market. The great majority of home buyers are cautious. In fact, 82% of people in Boone County who buy a home and get a loan get conventional financing. However, there are some people in our community who are struggling with an adjustable rate mortgage that has reset at a higher interest rate. Today I'm talking with Diana Moore and Chris Sanders about options to help people who find themselves in a financial bind. Diana, I was wondering if you could tell us a little bit about your organization and what you do and what's available to help people.
Certainly. I work with Central Missouri Community Action. We are a community action agency and actually have been here for about 40 years. Originally, we were known as Central Missouri County's Human Development Corporation, and now the same organization, we changed our name to Central Missouri Community Action. We provide a lot of different services to help individuals. Our mission is to empower families and individuals to become self-reliant. And one of the core things we do is help people with housing issues. We help them with budgeting. We offer Money Smart classes. And the other thing that we do that we've just joined is a Missouri Partnership, Homeowner Partnership Foundation to help individuals who are experiencing the foreclosure issues right now. This is a part of a national outreach effort, and there is an 800 number that's available 24/7 to help individuals who are facing foreclosure. They're not sure what to do. They're not sure who to talk to. Maybe wake up at 3 o'clock in the morning in a panic when their phones are ringing from their lender and they're too scared to answer a phone during the day and they're panicking. And these are trained counselors. The number is 1-888-995-HOPE. And these counselors will help a family, an individual, go through and look at all of the options that might be available to them. I think sometimes individuals that are facing this, you know, they're too scared to actually understand that the bank and the lender really are partners in this, and if we can talk at the beginning before things get way too far along down the road, that there are solutions out there. And so that's why it's important, again, that it's 888-995-HOPE. And again, 24/7 individuals are there to help persons understand where they're at and what might be some alternatives and options out there for them.
That sounds wonderful. And if people can't remember the phone number, can they just contact you at Central Missouri Community Action?
They can.
Okay.
The number at Central Missouri is 443-8706, and my extension is 290.
Okay. And do you have an office here in town?
Our offices, well, our outreach offices are located on Wilkes Boulevard. Our central office and my office is actually on Providence, 807 North Providence.
Okay. And this is good for anyone. They don't have to live in Columbia.
Actually, we have offices located in 8 surrounding counties. So we cover Boone, Audrain, Cole, Callaway, Howard, Monotone, Osage counties.
Okay, wonderful. Sounds like you're reaching a lot of people. Chris, you know a lot about some other programs that might work. For example, I wanted to ask you about the FHA Secure program because that's been on the news, but nobody really knows anything about it.
Sure. Well, I wanted to say thank you very much for having me tonight. I wanted to certainly let you know that help is on its way in the form of a newer FHA loan, which is called FHA Secure. And to give you a little bit of history about the Federal Housing Association, is ultimately it was created back in 1934 as a way to allow homeowners of a low to moderate income nature to afford a home. So going back to 1934, it was established because ultimately you had about 2 million construction workers out of jobs, and money was very tight back then. So this was passed and approved by Congress to afford people to have a home. So as it developed over the years, during the 40s, 50s, and 60s, FHA was there to assist consumers with relatively low down payments to afford a home. As military and the veterans came home, even during the 70s and 80s when recession was upon us, and a lot of these, to go back a step, FHA is ultimately a private mortgage insurer. Okay, and what that means is that a lender will give you the money, extend the monies in the form of a mortgage to be paid back over time. And a lot of consumers believe that FHA is a lender, a direct lender, and it's certainly not. What it's there is a federally chartered backing that will allow a consumer to have a mortgage funded by a bank. Okay, and if that person defaults on the mortgage, then private mortgage insurance would be instituted. And during the 70s and 80s, when a lot of these private mortgage insurers pulled out of these oil-producing states, it was very difficult to get a mortgage. So ultimately what you have is FHA has always been there since 1934. In 1965, it became a part of the Department of Housing and Urban Development, also known as HUD. So you have to be a direct approved lender to do an FHA type loan. FHA is not its own, they don't lend money directly. So there are several local banks here in community and mortgage companies in surrounding areas that do FHA loans. So as part of this mortgage liquidity crisis, to assist homeowners that may have an adjustable rate mortgage that is resetting between June of 2005 up to December of 2008, FHA has created this FHA Secure Loan. And ultimately what it's designed to do is assist consumers or homeowners that went out and obtained a non-conforming or subprime mortgage that was on an adjustable rate mortgage or an ARM that is going to be resetting between these periods of June of 05 and December of 09, or December of 08, excuse me. And what FHA has come out with is some guidelines. And based on what we know right now is that if a consumer falls behind on their payments as a direct result of a resetting adjustable rate mortgage, FHA will look to do that loan. In other words, they would refinance that loan into another payment or a smaller interest rate, lowering their monthly payments. Now, if FHA under this program states that you got to prove your income, okay, they don't do any type of stated income or loans where you have difficulty documenting what you make. Also is if you can prove that you have your other debts and obligations were delinquent as a direct result of having a resetting ARM, FHA will come in and do that. There is no actual length of time that you have to be delinquent after that ARM is adjusted. So in other words, let's say that you got your paperwork in December, and starting in January, your rate's going to go from 7 to 12%. And you know that you can't afford that interest rate change in your payment, and the payments start falling behind. Well, FHA will come in and allow you to refinance that mortgage to a lower interest rate, better program, even though you may have been 30 or 60 or 90 days late, and ultimately avoid foreclosure. So roughly the estimates between 2007 and 2009, about 2.3 million consumers, 2.3 million mortgages are set to adjust, which ultimately about 0.25% of that's going to be affected and possibly foreclosure, which amounts to about 600,000 families may be directly affected because they have a resetting adjustable rate mortgage. So what FHA has done is they put some restrictions on this, but they've kind of opened up that you have to have at least 3% equity in the home. You have to have a proof of payments that were on time prior to your mortgage resetting, and also somewhat of a stable employment, and also the ability to prove income. So certainly this program was designed much like the 70s and 80s and the recession time, where a lot of these privately held mortgage insurance companies were not offering any type of loans. FHA currently insures over 35 million consumers on this types of transactions.
Okay, I guess I had a couple of questions then. There was a time when houses had to pass a certain inspection in order to qualify. Are they going to do FHA inspections on the homes?
Well, FHA has certainly moved away from some of the stricter guidelines based on an appraisal. And what it used to be is if there was a screen missing or a doorknob unscrewed or a banister unscrewed, they really scrutinized that the integrity of the home, and they've gone away with that. So they've kind of loosened up those guidelines a little bit in order for people to come in that have possibly a fixer-upper that needs some repairs as a purchase transaction, as long as they can show that they have at least 3% into the transaction, will allow them to buy the home. And they can get that from a city-assisted program or a grant program or a non-for-profit organization. And there's several of them. If you go to, I think it's www.hud.gov, there are a lot of programs that you can look through to see what you're eligible for, because FHA doesn't necessarily underwrite a loan based on a specific credit score. They look at the total package. In other words, kind of the old way bankers used to do it. They used to underwrite based on, well, number one, income. Number two, how well you've paid your debts. If there has been some type of unforeseen circumstance, such as death or an accident or even possibly divorce, that has caused your credit to go down or suffer, FHA, they look at that and take that into consideration as well. They really want to extend money to you. They really want to give you the benefit of the doubt. But I think there has been, over the last few years, a lot of non-conforming lenders going out there and ultimately preying on the unsuspecting first-time home buyer and putting them into a mortgage that they knew full well that a couple years down the road they couldn't afford. And then that's ultimately what's happening right now.
Right, okay. So we also need to encourage people to be smart when they go in to buy originally, to make sure they can afford the home. And I guess that brings me to the reason I originally called Diana, is they have a special program for low-income people to buy. Could you tell us a little bit about that?
Well, we are one of actually 3 CHODOs in the city of Columbia. And a CHODO is a community development housing organization. And we receive funds, actually our funds come from HUD through the city of Columbia, that helps to build affordable housing. And what we do is we're in the process of building one house now on Hayden, and we also have 2 houses that were built prior that we have available for sale. And what happens is that we use these funds to build a house, and then the funds also help to provide down payment assistance, similar to what was talked about with the FHA, in the sense that we can, in some instances, up to about 20% of the cost of the house, we can provide as down payment assistance. So, as an example, one of our houses that we have available on Worley, we're asking $80,000 for. It's a 3-bedroom, 1-bath home. And with the down payment assistance that we have available, an individual would maybe only need to get a loan for around $65,000. And so it's a really good opportunity for a first-time home buyer. Now, the first-time home buyer still has to have a conventional mortgage for that $65,000 piece. We ask that they have $500 at least of their own money into the project, and then we subsidize the down payment assistance, and that's taken as a second and third, so that if the house actually is lived in for 10 years, those are forgiven and don't have to be paid back. But if the house would happen to be sold, then we have a second and sometimes third position. But the key is to get individuals into homes to build assets. And we require that they take a first-time home buyer class so they understand what they're getting into. And we also encourage them to take budgeting classes and Money Smart classes so that they also understand the whole idea of budgeting, not only home ownership, but budgeting and what all is involved with that. So it really is a good opportunity for individuals that want to buy their own home, but yet I think it's a part of a package of the knowledge base and education piece that all really wraps around successful home ownership. Again, understanding what's involved with mortgage insurance, understanding what's involved with home ownership, and in some cases, what kind of assets maybe you have to do to improve your credit rating, and taking those steps initially, and then build toward the home ownership. So, one of the things that we can do is to help an individual go through that, and we have another program actually that is a Missourians Building Assets program that helps individuals save. And one of the results, and we actually match their savings that then can be used for down payment assistance, or that can be used as their asset going into buying a home as well. So, that's an example of some of that assistance that can be available. Again, the more a person of low and moderate income, one of the keys to home ownership is it is an asset, and it's an asset that an individual can pass on to their children. They can use it to move, actually helps them to move out of poverty. And that's what we're really about at CMCA, is helping individuals to move out of poverty. And so this is one way that we can help to do that.
Yeah, that sounds wonderful. Well, is there an income limit on somebody who wants to do the program? There
is. It's 80% of median. Again, a lot of these funds are wrapped around from the Department of Housing and Urban Development. And so, for instance, 3-person families, the maximum would be, annual income would be $44,600 that they can make and be eligible for participation in the program.
Okay. And what about, as far as, you said they had to be able to qualify for a conventional loan, so they have to have built credit a little bit?
They would have had to build a little credit. Now, sometimes we have individuals that come in and their credit isn't so good, and so what we want to do is we'll work with them to help them rebuild their credit. And so they may not get into the house today, but then we'll work with them to build their credit so that then they can move into a house tomorrow.
Okay, well that sounds great. And you said you do have some houses that are completed and available?
We have 2 houses currently. One is on Oak, which we actually are currently in negotiations on getting ready to sign a contract on. But we have one on 416 Oak, 119 Worley, and 3020 Hayden. And the one on Hayden Drive we're just completing construction on, and hope to be able to have, it will be available the first part of next month.
Okay. And do you have, who built the houses? Is it just any builder, or is it a special building program?
We work with Youth Build here in Columbia, and they actually are, and it's another HUD-funded program that actually works with individuals from 16 to 21 years of age who have dropped out of school. It teaches them construction trades, and then it also requires them to complete their GED, and is a wonderful opportunity for training individuals. And they actually work with us and have constructed the houses for us.
Okay, that sounds great. Chris, I had another question about the FHA again. You were talking about how in order to qualify for that loan, it's not really a bailout for just anybody. You need to be able to prove that you have income, a job. So does that mean that the mortgage industry is getting away from the stated income loan?
And generally, yes. I mean, the stated income loan was ultimately a derivative of a conventional loan. If you had somebody with a very strong credit score, 20% down, you don't need a whole lot of documentation to validate that loan approval. But as the mortgage industry started to morph into this juggernaut of refinancing and these 80-20 type loans, and what I mean when I say 80-20, it was a first mortgage at 80% and a 20% second mortgage combining to the total purchase price of the home, is ultimately you're going to see a huge exodus away from that stated income type loan where you just state whatever it is that you make. Lender would say, sure, we believe you because your credit score was high enough. There still are some conforming conventional loans that are of a stated income nature, but generally those require more money down and a higher credit rating. But a few years ago, if you had less than a 600 credit score, like 580, you were still able to state your income. So ultimately, what you have is a return back to somewhat of a normalcy in lending. You have to document your income. There still are a lot of good 100% loans out there that can use your second mortgage and third mortgage as a silent second, so to speak, that are 100%. Now, they are median income driven as well. You have to make under a certain amount for the area in which you live. The loan amounts have to be under a certain amount as well. But yes, to answer your question, is that you're seeing a huge fallback from stated income lending as a whole.
Okay. And I was also kind of curious, how has, I see how lending has changed. What do you think, this is just your opinion, what do you think made it turn into what we did have with the no documentation type loans?
Well, everyone's trying to point their fingers in one direction as well. It's their fault. It's the broker's fault. It's the lender's fault. It's Wall Street's fault. I think it's a culmination of efforts, to be honest with you. I think that these monies were made available. These programs were opened up and made available to the public. And it certainly made it easier for a consumer that was leveraging some of their equity. They were selling at a great time, making some good money. They were putting down some money, doing a pay option arm, which is they get 4 different choices every single month to make a payment, whether it's an interest-only loan, whether it was an 80-20 loan. A lot of these things were funneled through on a huge scale that ultimately the legs just got cut out from under them, is that Wall Street ultimately wanted a higher rate of return. So they opened up this warehouse lending avenues where you were able to give a certain lender a large amount of money to say, go out and lend whatever way you would like, loosen up your guidelines a little bit. We want to see a higher rate of returns on Wall Street. And ultimately, that's exactly what was happening, is these programs were loosened up, lower credit scores were offered, no mortgage insurance, a lot of higher rate loans on a first and second mortgage that were a short-term loan, whether a 2-year ARM or 3-year ARM, meaning adjustable rate mortgage. And ultimately, consumers were refinancing, okay, because as rates started going down, rates got better, they refinanced they pulled more money out of their home. They may have taken on a second mortgage, consolidated some debt, took on more money, so they're able to afford their payments as this was churning effect. Ultimately, the tide was in. Everybody was happy. Well, ultimately what happened was in the fourth quarter of 2006, a lot of these bond funds were not AAA rated anymore. Delinquency started to happen. And as these bond funds were downgraded, ultimately you had Wall Street cutting off lines of credit to lenders, or wholesale brokers is what they're called, meaning they're getting their money from a higher entity, Wall Street basically. So what you had was you had these lenders virtually going out of business overnight, whereas you had a program that said, okay, you have a 560 or 580 credit score. And what I mean by that is each consumer has somewhat of a credit score. If you went out and borrowed money, you have some type of number attached to your credit, whether it's 500, 600, 700, 800. You have 3 major credit bureaus that report to give you a score. So ultimately, these programs were discontinued, and what you had is increasing delinquency. So as the market started to stagnate a little bit, people could not reach back into their equity potential and pull back out, pull the money back out in order to make payments again. So ultimately they were faced with a foreclosure situation where they knew that they were tapped out of their equity. They knew they couldn't refinance because the home that was now worth $150,000 6 months ago may be worth $140 now, and they owed $150 on it. They couldn't do anything, so they were virtually caught in a trap. Their credit had not gotten any better, and those programs basically were discontinued, so they were stuck. And that's why you saw a lot, and you continue to see a lot of foreclosures. Ultimately, it's going to get a little worse before it gets better. As of right now, early estimates are, I think it was $27 billion in foreclosures in October. By January 1 of 2008, will be upwards of $55 billion. And that's why FHA Secure Loan is certainly wanting to help. They're not going to help everybody. Some raw numbers are roughly 240,000 consumers. But if you see a problem ultimately going to happen, get involved with a lender as quickly as possible, or a program like yours as quickly as possible, to see if there's any assistance or available help. Because if you have a rate that's going to adjust and you know that you can't afford that change, ultimately FHA still has these programs available now. Even let's say that they haven't been late, FHA still has guidelines available where they can refinance into a better performing loan right now. Started September 5th of this year.
Okay, good.
And I would like to say again, 1-888-995-HOPE. That's the number to call when you hear, you get your notice, and you start really wanting to figure out what to do when you're in this situation.
Well, good. I'm so glad both of you came on, because these are things people need to know about. These are things that are not normally on the news, but people really need to know because they need help. So thank you, and it looks like we're out of time.